Good evening, everyone. Time for another silver update. This is the 30-minute chart of silver provided by netdania.com. You can click on the link below. Now, what I've outlined here with a number of support and resistance lines is the beginning of stair-stepping pattern we're starting to see now. If we draw in some of the diagonals, you can see some of the stair-stepping that's done here, how that works. Here's another diagonal here. Now, actually, this is a normal market phenomenon to see this type of stair-stepping. This is what you see in normal markets. The reason why, as I pointed out before in other videos, I call this the reverse battering ram effect that you're seeing here. And it has to do with support and resistance. As I pointed out before, there's always people waiting to sell. When they get even, that's what creates resistance. And there's people who are waiting to buy and get in at a cheap price. That creates support. And so those are the two main factors that you're going to talk about when you're talking about technical analysis. And I'm not talking about Gann ratios, Fibonacci's, and all that stuff. I'm just talking about the plain old supply and demand, buying and selling type of action in a market. Now, as I was saying, this is understandable and explainable, this type of pattern in a normal market, as Jesse Livermore pointed out many years ago, that this reverse battering ram effect is where the price will test a certain point and then back off, but does not back off as much before it tries to break through again. Then it doesn't back off as much as the last time. Sometimes it will bash through the door and then fall, but ultimately it gets closer and closer to that until it breaks out, and you get a breakout. That's how you get breakouts. Here's a breakout here. Now, the reason why that happens with a battering ram, you back up farther and farther until you get enough energy to bust through the door. With markets, you get closer and closer and closer until there's so much pressure you blast through. So that's the idea. That's normal. That's expected in freely trading markets. When we talk about the silver suit, and we're going to be doing a number of videos on the silver suit. This is just going to be an introductory one, the first. But as we look at the silver suit and the allegations there, we have to look and make assumptions based upon what the plaintiffs are alleging. And that's going to be the main reason why that was thrown out. But before we get to that topic, I want you to look at this definition here, because we're going to talk a little bit about market manipulation. This is the term max pain or maximum pain. And what this means is it's a term about option expiration. I'll read the definition. The point at which options expire worthless. The term max pain stems from the maximum pain theory, which states that most traders who buy and hold options contracts until expiration will lose money. According to the theory, this is due to the tendency for the price of an underlying stock to gravitate towards its maximum pain strike price, the price where the greatest number of options in dollar value will expire worthless. So, to make that easier to understand, we're going to go to a bunch of Apple options. Now, I don't have the Januaries because they expired on Friday. That was options expiration. And that's what we're going to dig a little bit deeper and look at. But just looking at the February options, you can see here, I've looked at it earlier to see, for January, max pain was 500. And but if we look at, well, there's multiples because of different contracts. But in the February Apple option, max pain is actually at 600. The way you calculate it is you just find the largest number of puts and calls and whatever open interest added together at what price is going to equal that max pain. So we've got about 54,000 on the calls. We've got about 7,000, I think it was, on the puts. There's not nearly as many puts written on Apple. There's actually, see, 16,000 at 500, but at 600 there are only 7,000. Actually, yeah, 7,000. So there's less on the puts. So if you're going to talk about max pain, you have to add together both the puts and the calls to get the largest number. So right now, for February, max pain is going to be at 600, even though for the puts there's more at 500. But anyway, I wanted to explain that to you to show you what happened with Apple stock. Now we're going to be talking about market manipulation and how the lawsuit was dismissed for the silver manipulation on the basis of lack of proof. It's very difficult to prove a conspiracy. That's one of the hardest things to do, and that was the task that was required for them to succeed in their lawsuit, which obviously they're not going to. Now, what I wanted to show you here is the closing price of Apple. This is the closing price of Apple on Friday. That becomes the settlement price of the options for Apple Computer. Apple Computer closed at 500.00. You can see it's quoted down to hundredths. So it's actually quoted down to the penny. And yet it closed exactly at 500. So this is Max Payne version 2, and let me explain to you why that's important. Only at this price and this price alone, you can imagine Apple closing at 500.01 or 499.99. There's only 2 cents difference between those three prices, but there's a big difference as far as options are concerned, and I'm going to show you why. At the price of $499.99, the puts actually expire in the money. At the price of $500.01, the calls expire in the money. So this price here, $500.00, is the only price where both the puts and the calls expire worthless. Now, you tell me, I can understand with cross-trading of different platforms and hedging of risk, and especially arbitrage between stocks and the options that are written on them. I can understand how Max Payne can have an impact on price, but I cannot understand how the price can close exactly at 500.00 if this is a freely traded market, if this is participants on both ends buying and selling, and that's what they're interested in. The buyers want to own the company, the sellers are tired of owning the company, and so they have fundamental reasons for doing so. Obviously, the chances of this occurring are probably 1 in 10,000 or even more. So that's not random behavior. That's the type of thing that you see, but you cannot prove. And that's what is alleged in the silver manipulation suit. Now, I'm going to first read from the 104-page allegation, and I'm going to spend subsequent episodes going through the specifics of the allegations and the court's reaction to them, because this complaint document is 104 pages and the judge's answer is about 80 pages. So there's a lot to go through here. I'm just going to do a general overview. But one of the things that I noticed in point 160 of the complaint, they write, according to the LBMA, the London Bullion Market Association, the following 10 banks have elected to be market maker for spot silver and, quote, two-way prices to each other during the London business day. The Bank of Nova Scotia, Barclays, Bank PLC, Credit Suisse, Deutsche Bank, AG, Goldman Sachs, HSBC, JP Morgan, Mitsui, Societe Generale, and UBS AG. Those are your 10 banks. Now, does this look a little bit familiar? Remember the LIBOR scandal? Remember what happened with that? These banks were all calling each other and telling each other what their creditworthiness was. And they were basing the LIBOR rate, which is the most important interest rate in the world, they were basing that on lies that they were telling each other about their credit worthiness. This looks very, very similar. So the silver market is controlled by these banks by making quotes back and forth to each other for the price of silver. And the judge goes into a lot of these allegations specifically, and to be perfectly frank, from what I've read of the complaint and from what I've read of the conclusion by the judge, and I haven't read everything, I've read about half of the complaint, and I've read about 30% of the judge's argument. But from what I have read, this seems to be a very, very poorly put together lawsuit. At least it's very convincing when we get to the facts, and we're going to do that in subsequent episodes, of what they allege and the evidence that they do have, such as very, very strange anomalies in the price of silver and the charts that show that, and a lot of other things, including what's alleged about Saxo. There's a lot in here. But as far as how they can, under the law, succeed, that's a whole different thing. And I wanted to take you over to the judge and what he wrote, and it's very interesting. First of all, before we go into that, I want you to note here that it was very important that this be dismissed, and that's what happened. It was dismissed on December 12th, 2011. JP Morgan Group defendants filed a motion to dismiss the complaint pursuant to Rule 12b-6 of the Federal Rules of Civil Procedure. The defendants' motion to dismiss. While argument was pending on the motion to dismiss, plaintiffs filed a motion to compel limited discovery on April 17th, 2012. Now, this is very important because this motion to compel limited discovery, first of all, you need to understand what discovery is. In a lawsuit, both sides are allowed to discover information that the other side has. And they are also allowed to subpoena and try to get documentation. If they know about something, they can ask for it. Sometimes they can kind of go on fishing expeditions, but this is the stage in a trial where a lot of things can change because of this power of discovery. What the plaintiffs were asking for in this case is that the judge allow them limited discovery. In other words, they wanted to do a little bit of fishing in of what JP Morgan and the others, I think HSBC, that's something we're going to have to cover as well later, but HSBC was allowed to drop out of this suit. But the limited discovery of JP Morgan's documents is what would have happened if this would have went forward. And that would have meant that one of the big things that came up many times in this dismissal was the CFTC and their investigations. You have to remember that the CFT has twice investigated whether silver is manipulated, and the judge cites that the ongoing investigation is 2 or 3 years running, and there has been no finding of criminality. Therefore, the judge concludes that the CFTC information ends up supporting the defendant in this case. So one of the things that they wanted to discover and really wanted to look at was what led Bart Chilton to make his statement. You remember the famous statement that he made at one point saying that there was evidence to believe that there was manipulation of the silver market. Now, the CFTC obviously had a lot of documents that they looked at from JP Morgan and others, and I think that the plaintiffs in this case wanted that information. They could not get that information until they were allowed discovery or the trial went to the discovery phase. That's why they filed this motion for limited discovery, probably hoping to find something more to make their case that the silver market was in fact manipulated. So in subsequent episodes, we're going to spend a lot of time looking at the allegations and looking at what the judge said about those specific allegations and dig into that to see why it was dismissed. But the main point is that not only was the suit dismissed, but the motion to compel limited discovery was also denied by the judge. So we'll go over the facts later. There's just too much to go over. But as you can see from Apple Computer closing at 500.00 on options expiration. You have to remember that January 18th was options expiration. So it's only important that it close exactly at that price on that exact day, at that exact time. So on that exact day, at that exact time, it closed exactly at that price, which made everyone who held call options in Apple Computer at 500 went worthless. Everyone who held put options on Apple Computer at the price of 500 on that date and time went out worthless, and all the people who sold those made a lot of money. And of course, maximum pain teaches us that the price that it will close at is where most of those options were, and that's exactly what happened on Friday. The vast majority of put options and call options, as far as price weight, were at that $500 price, and it closed at 500.00. So there are things that are so obvious that you can't prove, and that is an example. Also, the manipulation in the silver market, even though you can't prove it, there are things that prove to you that it's true, and hopefully we'll be able to show that why that's the case when we look at the rest of the information that was in the allegation, and the judge disagreed and his reasons for doing so. So back to the silver price. Again, as I pointed out, we're doing the stair-stepping, which is a normal type of thing to see in a market. Now, what is not normal to see in a market is something like this, where you get a drop from 31.21 down to 29.64 in literally a matter of minutes. And that was also alleged in the lawsuit, that the type of trading that was done was not the type of trading that one would do if one were trying to make a profit. And that's been alleged by a number of people, that that's what's gone on in silver, is that the people who are buying and selling silver are not operating as if they're trying to make money by their trades. So there are massive sell-offs like this one here, and they would make more money if they did it in dribs and drabs rather than putting the price down on themselves. So that's the allegation. Unfortunately, I haven't gone far enough, but I believe from some of the things I read in the judge's wording that that may be the case, but there's no law about that. In other words, that's not a legal principle, that someone has to trade to not lose money, or trade in a way that would benefit them rather than trade in a way that would harm them. So there's a lot of factors we need to look at, and we'll do that in subsequent episodes. So we're going to watch this week. We're going to see if the stair-stepping stops. You can see that we've recovered most of the smackdown. Now, it's very interesting that this smackdown, we are now out, as I pointed out in the last episode, we're out of the Silver Eagle for 2013. Now, it's very interesting that the timing of that if we go back to that chart here, the timing of the sellout of the Silver Eagles was during last year, was in late December time frame. It was during this time frame. So even though the prices were dirt cheap, there weren't any available. Then you can see the price came up and dropped really hard, and then of course we got Silver Eagles for sale during these few days at the beginning of January, and then the door is shut, and there are no more Silver Eagles available just as of just a little over 2 weeks or so. So based on that, if the theory is going to be that the mint is looking for higher prices for the Silver Eagles, I don't know why that would be the case unless they're having problems sourcing blanks at the current prices, and that's going to be more evidence that the market is breaking down. But if it turns out that on the 28th we have significantly higher prices somewhere around in here, and they start selling those Silver Eagles again, then that's going to be something that's going to give a number of people pause about what the reason was. So we're going to watch that very closely as well, and we'll talk to you next time.